So we are live now.
Yeah, I think so.
Okay.
I think it comes with a little bit of a lag on the iPad. So I'll just see. Yeah. Hi. Welcome to this masterclass on factor investing, where we're going to discuss a very interesting paper that was written by AQR, the authors are from AQR, and it covers a lot of points and like the paper says, some fact, some fiction about factor investing. What we thought was, we will put it into an Indian perspective, and to help us do that today, we have a very distinguished speaker, Mr. Rajan Raju. Rajan is a career banker and has worked at Citibank, DBS, and has been working in various roles in investing, corporate banking, technology head, and in his current avatar, he's managing his family office, but at the same time, he's doing enormous amount of research on asset pricing models in India, with particular focus on India. And I myself have learned a lot interacting with him and having co-authored a couple of papers with him. So, with that, let's go into what we are planning to cover today. This is the disclaimer that we're not here to give you any investment advice. This is just an educational seminar. So, what we're going to discuss today is we start with what are factors. Now, factors usually understood in the form of academic factors and what we do in practice. Then there are about 10 points that they've covered in the paper. We sort of try to distill it all within 5 6 points, and then we're going to show you a very short case study in terms of how you can use some of factor analysis to look at even discretionary investors, how, because ultimately everybody has exposure to factors, so how you can use that to analyze any investment portfolio, any mutual fund, and then we'll get into Q&A. But at the same time, if you have any questions, please do type in the chat box, and we'll try and answer the queries as we go along. So with that, Rajan, it's over to you.
Thank you, Anish, and thank you for having me in this good chat. I'm looking forward to continuing our ongoing collaboration, and I'm sure that we'll get some pretty good questions from whoever is out there watching us. So first, the factor horse race. This is something that keeps coming up every year. It appears in the press also quite a lot. And frankly, all that we want to say is that there are multiple factors. Uh, Unfortunately, the way factors work is that they're not always winners. In the horse race that happens every year, there'll be some factors that win, uh, but it is not that you can predict the factor that's going to win at the start of the year. Of course, on hindsight, it is always very clear as to which factor should have won. Uh, but as I say, hindsight is 2020 vision. Foresight is where really the challenge comes up. Anish actually puts out the factor horse race very nicely every month. So if something that you guys are interested in, you should be looking into the work that Anish and QED do on this. Could we go on to the next slide, Anish? Anish, could you go on to the next slide?
Yeah.
Great, thank you. So what are factors? Factors pretty much are investment styles. They're very fancy words that academics use, but as general investors, we all know what factors are like. So when we say value, value is kind of a factor. All that you're trying to do is to say that I'll buy companies that have got value in some way or shape. What the metric you use to measure value may be different than your neighbor, but both of you are looking at value. When you're looking at momentum, somebody may say, I look at momentum as 12-month price return. Somebody else may say, I look at it as 3 months total returns. If you leave the metric aside, the underlying concept is the same. That these are investment styles that, frankly, would deliver returns, and the important point being over the long run. Uh, If there was something that kind of delivered consistent returns all the time, then everybody would be in that space and that would get arbitraged away. Factors, because they're not arbitraged away, do have, while they earn premium in the long term, they also have risk in the short term. And that's where factors underperform, possibly in the short, may even be in the medium term, and what Anish and I call these as bad times. There are multiple types of factors. There are the static factors, things like if you do a simple 60-40 asset allocation between equities and bonds, you're effectively doing a factor um, asset allocation. You could also think about changing your weights consistently every year, every month, every day. That's a dynamic process. You may think about factors that use macroeconomic variables, and when you do macroeconomic variables, then again, that's another external factor that you're using. Uh, I want to reiterate this that factors earn money because they do have bad times. So it is you're in a factor because it will deliver to you returns in the good times for losses in the bad times. And I think as long as one is very clear about that, factors then become pretty easy. Uh, and if you could go on to the next slide. The traditional approach to investment has always used factors, whether you call it the equity bond mix or you have a large cap, small cap mix, or you decide to say, I want to do domestic, international, or you want to do, between gold, add a asset allocation into gold. All of these are factors because each one of these are assets that have got an underlying factor risk and an underlying expected return. What that means is that if I was to take Indian equities and we were to take it as a macro class, right? That means we don't really break it down into large cap, mid cap, and small cap. There is an underlying expectation of returns that you would have for Indian equities, as well as an underlying expectation of risk. You may then say, look, I'm only looking at the Nifty 50, and the Nifty 50 will give you an underlying expectation of return and an underlying expectation of risk. That would be very different than if you were, let's say, looking at the mid cap 150. There you would expect that the returns would be slightly higher for the mid cap because you're taking on a bit of extra risk, and that risk could be defined either in the form of volatility or it could be defined in the form of drawdowns. Our own view on risk is we're not stuck to one kind of definition. I think you should have a kind of a broader definition of what risks are to your portfolio. Anish, we could go on to the next slide. The key thing as one thinks about factors then is most when academics got into the equation, they started to look for what is the rationale as to why there's a factor. Because if you go back to the Kaplan theory, which Markowitz won his Nobel Prize on, basically he found a way to abstract returns towards the market, which became the single factor model. And then what academics then started to look at is they said, well, there are these returns that we are not able to explain because the CAPM was not able to explain average returns of portfolios. And then they start to look for anomalies. These anomalies were usually empirical, so therefore they went through data and kind of massaged the data until they found that there was a difference. But the way they did the empirical study was actually pretty smart because if you already have the market factor, you're going to look for a second factor. You need a second factor that is not correlated in any way to the market factor. So you have to kind of extract out the return series that is residual after the market factor. Again, when Buffett says he talks about value, or any of the value people talk about, when they say they're doing value, what they're trying to tell you is, I'm going to get you a better return because cheaper companies, or the way I've defined value companies, outperform the market. So that's the second piece. That is usually relative. Factors by themselves may not do very much. They may not have an absolute return. They always are relative to something else. And the relative to something else often comes out to be the market. Now, academic factors tend to be long shots and therefore they are market neutral because of the way that they are designed. They're not supposed to be replicated portfolios. They are portfolios that will help you understand how returns are to be explained. When you want to implement a factor, normally you would buy a long only portfolio. And when you buy a long only portfolio, what you're effectively doing is you're kind of making market weights, the portfolio weights, different from what the market weights of those individual constituents of the portfolios will be in the market portfolio. And because you have this selection, which is you'll have different stocks, allocation, different weights, and possibly timing, you're going to get hopefully an alpha or a return on top of what the market does, right? And that's really the basis of uh, how the factor investing process works. I just want to say that whether you do it on a rule-based manner or a active, systematic manner, where there's a guru who kind of tells you that, look, I know I can see value better than anybody else, or I can see momentum better than anybody else. They all have an economic rationale, and the rationale is that they are selecting stocks based on certain characteristics which are going to outperform the market. Anish, could we move to the next slide, please? The important thing to remember is that that economic rationale that we talked about, that usually comes across, most academics will talk about it in kind of three broad areas. One, they'll talk about it from a risk perspective. So they go back into the way they have constructed an abstract model of the market and try and figure out why that particular anomaly or that particular extra return is being earned. So for instance, if I was to take momentum, the economic rationale for why momentum actually happens is that they say that winners tend to keep winning because of the way the market reacts to that winning news. For value, it is basically that cheaper companies, in whichever manner you define, tend to offer higher returns because of underlying dividend growth model. Where then comes the second aspect, which is the behavioral aspect. So people, not all investors have the same information. Not all investors have the same risk utility curves. And there's always going to be a difference between, let's say, Anish and me. Anish may be a bit more aggressive than me. And so for Anish, when he thinks about a momentum stock, he's quite happy to get in there early. I want to get out of that stock. And therefore, I'm going to tell Anish, you can please buy my stock. Anish buys my stock, makes a lot more money. But that's because I have seen the price of that particular stock reaching my target. But as for Anish, there's a lot more to be uh, there's a lot more to be gained from that particular stock. And that comes into in momentum, you'll see the underreaction to news and delayed overreaction to price trends. Similarly, in terms of quality, I may choose to buy a quality company because I want to get large benefit out of it. So, because I want to get a large benefit out of it, and there's a small downside, let's say I look at a company like, I'm just making this up, uh, let's say we take a company like BYD, which is a car company in China, and I may say, look, I see it as quality because there's very few people who look at BYD in any great shape. I know if it clicks, it is going to give me a tremendous amount of upside, and I can tell on hindsight that that was a great quality company. So often those lottery-like preferences that I have may tend for me to choose a lottery company or a company that gives me a significant upside for a limited downside. The other thing is, I may know technology a bit better than, let's say, Anish. Actually, it's the other way around. Anish knows technology a lot better than me. So if Anish is going to look at, let's say, a Zomato, and he goes into a Zomato, whereas I have very little idea of how the Zomato business model works, my appreciation of what Zomato's good characteristics are going to be very little, whereas Anish knows this very well. So in the marketplace, then, I would be a natural seller of Zomato. Anish would be a natural buyer of Zomato. Which gets me to the last point that for a factor to really work, you need to have a sustainable pool of investors who are constantly on the other side. So if you're doing momentum, you need to have people who are willing to sell you momentum stocks because they feel that's reached its peak, or they feel there's no other juice left in this stock. If you do not have that, then frankly, the factor doesn't work. This is one of the most important things that one has to think about as to when you look at factors, because I can build a great data mining model, but if I do not understand why that particular characteristic is giving me outsized returns, who the other side is going to be when I get into the market, likely my actual results will be significantly lower than my theoretical results that I got on my backtest. Anish, could you just move on to the next slide, please? The one thing about factor investing is that people come up with some really nice backtests and they'll show you last 10 years, last 5 years, last 7 years. Uh, and the key point to remember there is if you torture data long enough, it will actually do whatever you want. As they say, lies, lies, and damn statistics. Uh, in the hands of a reasonably competent person, you can draw graphs that make intuitive sense. But the reality is that factors are not arbitrage opportunities. So when they draw you a chart that shows one line diverging very differently from the other line, then you got to ask yourself this question: why is that happening? And what happens when bad times comes in? So just remember the three things that we just spoke about, right? You're getting paid to take additional risk, which means that there will be periods of bad times, and what happens during the bad times. If over the last 10 years there have been no bad times, frankly, that back test may not be really strictly accurate. Second, understand why there is another side and what the behavioral underpinnings of the other side are going to be, because that will determine whether the person is actually going to sell when you want to buy, or there'll be a buyer when you want to sell. We do know that in the case of India, there's going to be there's another market complexity because a lot of the liquidity sits at the top end, and as you get lower and lower down the market capitalization size, volume starts to shrink quite a lot. All of that, Anish, if I go on to the next slide, all of that comes back to the three or four things that one should look out for when they actually come and share these factor back tests. Um, the first one is there potentially could be a sample bias. The sample bias could be just time or it could be with data. So always better to ask why something has been done. Second, has there been enough robust statistical tests? I think one good practice which people should do is to say, here are my monthly returns or daily returns. Please take them and do a test against them. If a manager is willing to do that, or if an advisor is willing to do that, that is great because then you can actually test these things out and then kind of try to understand the economic rationale. If we did these three things, then frankly, we will not really think about factor investing as data mining. There are a few other things that people tend to do. Anish, if we go on to the next slide, which is something that, again, I would say this is not necessarily the quant's problem, but this may be a marketing problem. Because just like when you get a freebie, always look out for what is the catch. And the catch usually comes across with these common assumptions that are made. And we as investors tend to make these leaps of faith. The first is they'll show you a study that is done in the US and then say, look, it'll apply to India too. There may be some broad correlation between the two, but the actual fact is that Indian market is very different than the US market. And since factors are empirical asset pricing models, you have to check what is happening within India itself. So the same factor could have an exposure or an expected return of, let's say, 500 basis points in the US. It may only have a 300 basis points in India. Or even if it has a 500 basis points in India, it actually comes out on the small cap side, where if you were actually going to invest into those small caps, you suddenly start to see a lot of slippage that happens because the liquidity is small, or you're not able to execute your trade as quickly as possible. The second thing is that they give you academic research, which usually comes out from long short portfolios, and then talk about their long only portfolio. Please remember that long short portfolios and long only portfolios tend to have very different characteristics. So that's something that one should watch out for. The other kind of misconception that actually happens is I'm going to give you a concentrated portfolio. So it's a bit like, I'm going to give you vitamin C, but I'm going to give you a really concentrated dose of vitamin C so that you'll get better faster. The reality is the body can only absorb a certain amount of vitamin C and the rest of it all goes out. So whether you have, all that you need to have is the basic minimum. So concentrated portfolios tend to have a lot more idiosyncratic risk. By that I mean the risks of those individual 5 or 6 names that are out there. So the reality is that these things tend to have uh, very, very low purity of factor exposure. So you may be actually taking on a lot of idiosyncratic risk rather than factor risk. The other one is that, look, I know this best. I've learned from so and so, so and so, so and so schools, and that's why I know this a lot better than you, and they'll throw you a lot of good statistical knowledge. Again, I would say when somebody goes down that route, also I would be a bit careful. There are very simple tests that you can use an academic factor portfolio. The important part is the academic factor portfolio is not supposed to predict how returns are supposed to be. All that it can do is it can uncover the explanation of returns for the portfolio that's being given to you or sold to you. So the important thing to remember is factor investing longer term. It does have bad times. And just because people come and tell you that they are giving you a factor exposed or factor tilt portfolio, that is not necessarily factor exposure. What you may be getting is market exposure plus some small exposure to the portfolio, to the factor that you're looking at. And that's something that you should be very thoughtful about how you're going to look at it. The piece that I wanted to show you is if you can just go on to the next slide. What I've done here is I've taken I put out a factor library for the Indian market. This has got about 4,000 odd companies. Every year it has about 2,500 live companies, so it's a kind of a well diversified basket. I follow the same methodology that Pharma French have used in their factor data set. So that kind of gives me the academic portfolios that factor returns that come out from the portfolios that get generated using the Pharma French factor methodology. And Pharma French is kind of one of the more popular factor data sets that you're going to find, or the methodologies that you're going to find. There are others, and there will be small differences. But some of the work that I've done actually shows that even if you have small differences in the way the portfolios work, the returns that the factors are, the estimate of returns of factors is actually not very different. The big difference comes when you have a difference between what is categorized by size. So in India, because we have a very long tail of size, if you have a lot of small size companies coming into your factor portfolios, what tends to happen is you get a lot of the small effect. So one of the things that the IMA dataset, which is an excellent dataset, their methodology to break companies into size uses the old Pharma French methodology. Pharma French have subsequently moved forward, and they have said that they wanted to avoid the outlier efforts for characteristics of small companies, because small companies can have a lot of movement in any one of the metrics that you choose. Pharma French then decided to just keep it to the big cap, large cap firms. So if you were to look at the IMA data set, you'll find that the IMA data set actually tends to show a higher momentum factor than what the data set that I put out. But that's primarily because the momentum from small caps or small size seems to be a lot more than the momentum from large size. But having said that, I just wanted to show you what I've done here is I've taken the long only portfolio. So BV is the big value, BR is the big robust. These are companies where they have a good profitability. Uh, Big conservative, BC is big conservative, where they actually have their investment is much more conservative than an aggressive company. And WB is the winner big. So that's the momentum. So each one of these is about 100 companies in there. and these are in the case of BV, BR, and BC, they're rebalanced every year. The WB is rebalanced every month. And then I've got value, momentum, and quality. These are the Nifty 200 indices around. The value is Nifty 500 index on value. The momentum and quality is the Nifty 230 index. So I've taken those. The Nifty indices are kind of rebalanced once every 6 months. They have a kind of a different way to weight the factors. So momentum, for instance, is not purely weighted on market capitalization, which is what BV, BR, BC, and WB are done. In the case of the Nifty momentum, they have a factor tilt to it, which means that the weights are more determined by the factors. The key parts that I wanted you to look at are the following. The first is that all of them have a reasonable exposure to market factor MF. So the market factor is fairly strong across all the three, all these portfolios. And now if I was to take the momentum portfolio, WB and momentum, you'll find that the exposure to WML, which is the momentum factor, winner minus losers, is more in WB than it is in the momentum factor. And this one is actually important because now you're starting to see that there are small differences in how returns get generated for each of these strategies, right? If I was to look at quality, the quality index actually shows equal exposure, and that is significant exposure to both robust minus weak, which is our profitability characteristic, and CMA, conservative minus aggressive, which is the characteristic around invest. How do you reinvest your assets? You'll also notice that there is something interesting that is happening on HML. HML is value, sorry, SMB. I'll come back to HML next. So SMB is size. So wherever it is negative, those are large or big, exposure to big. And wherever they are positive, they're exposed to small size companies. So value, which is the Nifty 500 ETF index, is really exposed to small cap, whereas all the other ones are more exposed to the big size exposure. And finally, I want to leave you with HML, which is the value factor. And you'll see value has got a really nice 0.88 exposure to the value factor. The last piece I want to leave you with is the R squared. So the explanation of the academic factors on each of the returns, monthly returns for each of these strategies is actually pretty good, all in the 90s, right? So just by doing something simple like this, just running a simple enough equation, regression where you have monthly returns on one side, the factor returns on the other side, it starts to show you how factor exposures come. And the important part is not all factor strategies are the same. With that, Anish, can I pass it over to you?
Sure. Thanks, Rajan. I think that was very detailed and insightful. Before we move on to the next one, I just want to ask a couple of questions which maybe people also have, and I may have. So, what is the uh, level of significance that you should look for? Say, it's if something has 0.25 exposure in the case of say BR. Now, is that enough, or should you be looking for something more than that? What is the exposure level that you should look at?
So that's a great question, Anish. Actually, from my own perspective, I actually look at the significance. So you'll see that there are things which have got 3 stars in them. So I look for 3 stars, which means that they are significant at a 1% level, which means that there's a strong chance that this thing is true. Then it comes into what is it that I'm looking for. So I actually go back and I will look at what are the worst case or the bad times for each of these factors and look at how much of a drawdown do I get, how much of a exposure downside do I have. And then I reflect that back into the portfolio that I'm trying to create. So in the case of quality, if I had a kind of a point 0.2, point 0.3 kind of an exposure, I actually, for my portfolio, for my particular characteristics, That's actually not bad. I would add quality in, because quality doesn't have necessarily that bad in down when it goes down. When it comes to momentum, frankly, because that can have big momentum crashes, I would be kind of looking at, can I get a higher exposure, because I may put less money at work against that particular uh, factor. So it's a kind of a depends answer, and it depends because of the downside in bad times that each of these factors have on the one hand, and the second hand is my own characteristics that I'm trying to get into my portfolio based upon my risk tolerance and my circumstance.
Got it. And when you say momentum crash, people use this, a lot of discretionary investors and a lot of other investors also talk about this term momentum crash. But are you referring to a long only momentum crash, or when you say momentum crash, are you referring to the long short uh, factor?
So here I'm actually referring to both. So even the long only has a momentum crash. The long only often tends to recover from those momentum crashes slightly slower than the long short version. So since since something that I would look out for in my looking at whether the strategy is good for me or not, I would kind of figure out how much time it's going to take for me to recover, because that then allows me to think about how much money I want to get exposed to this particular factor. So in this case, it is both the long short as well as the long only crashes.
So, say an investor or an advisor was looking at, this regression that you've done here, and now he or she is trying to sort of figure out what would be my expected returns from this. So, would they look at your long-term factor premiums, and how long should they be looking at? 10 years, 5 years, 1 year? How do they get an idea of? I think I we have that, I think, later in the
Yeah.
slide, but since we are here, I thought I'd just ask you that.
So obviously, the longer the time series, the better.
Better.
Uh, there are two or three challenges as I see from an Indian perspective. The first one is, if you look at our market is really matured only in this millennium. So if I go back into the 90s and try and draw up data from there, unfortunately, I think that the data quality itself is not that great, and so I may tend to have a sample bias on the negative side. The second thing is, if I'm looking at funds, uh, the SEBI did a big rationalization in 2018, and because the SEBI did a big rationalization in 2018, many funds kind of changed their strategy. They kind of adapted their strategy. They got compressed. So again, it'll be unfair for investor to compare a return from, let's say, 2005 to what has happened after 2018, especially if that fund was merged together with a second fund. There are clearly funds that have kept true all the way through, and those guys have been they had the AUM, they've continued with the strategy, and they've stayed true to the strategy. So of course, for those guys, it works out. So that's why I think India is a kind of a funny, our market situation is not yet fully developed, but we have enough data here to kind of go back as long as we can. So maybe 2005, which is where you'll find most of the indices go back to. So 2005 is a good start, and then start to make adjustments based upon your own understanding of the market. But the
No,
longer the better. Now,
yeah,
the other question
one
you asked
sorry, yeah, go
so the
on,
other
go on.
question you asked is, can I figure out returns from this regression? The returns don't come out from this regression. What I would tend to do is I would have the time series of the returns, monthly returns, and that's what I would use to estimate what the long term return expectations are. What this is all that this is telling me is that in this case there is none of these strategies, if any of these strategies actually came to me, let's say, as a standalone strategy, none of these strategies are actually showing any alpha over the market. So my bigger question here would be, is this helping me damp down volatility, which means because of the diversification that I'm building, is that improving the quality of my portfolio rather than giving me additional returns? Because in the intercept, I'm seeing no significant positive term.
Got it. So you're saying these are say the momentum index, for example, which is the most popular one,
Yeah,
at least until last year, was showing you higher returns than the market, but that was because you were taking on some additional risk,
that's right.
not because of any significant
That's
skill
right.
that you had, or not because you were still doing better than the market. So when you say alpha, because generally when in India, if you talk about alpha, there's anything above the benchmark is alpha.
Yeah, actually, it's something that Anish will talk about in a bit of time. Where we actually, at least from my perspective, I think rather than just use a simple alpha, one of the things that one people should use is how much return am I getting for the risk I'm taking, which is nothing
Yeah,
other than the Sharp ratio. So what we have done is we've kind of taken 3-year Sharp ratios. So it's a rolling 3-year Sharp ratios, and wherever
yeah,
there are negative Sharp ratios for 3 years, it means you're going to have bad times where you're going to underperform for at least 3 years. So if those things are there, you just got to be prepared to say that, look, I'm comfortable taking that risk because the upside is going to be a lot more. If I'm the unlucky investor who gets in at the wrong time, I may
yeah.
have to be a bit more patient than the lucky investor who gets in at the right time.
There is one last thing that I wonder about is because these are a lot of data that we have is after 2005 onwards,
Right.
and 2008 9 onwards we've been living in a world which has been in a giant monetary experiment, which is QE, and of course now we are in QT, which is tightening. So, how much of an impact do you think all that has had on factors? And is there anything that we can learn back? I know you said US data is not applicable to a large extent to the Indian markets, but are there any overall learnings that one could take from there?
So, again, Anish, a fascinating question. And I know there's a lot of debate going on around this. So my 2 cents are the following. I did a small piece of work around because there's such a large home bias in for Indian investors or Indian households. I was looking at what would happen if we started to introduce some international exposure, right? If the factors were the same from 2008, we should actually see that there will be very little differentiation between, let's say, an Indian portfolio that's 100% India, and let's say a 50% India and 50% international portfolio. What I did find is that there are certain markets where India is rather is correlated with. So let's say some of the some of the emerging market uh, stock returns.
So, Rajan, I think we.
I'm sorry about that. Uh, the
Yeah.
the 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 correlation with developed countries actually show that having some developed market exposure to Indian portfolios protected India from downside risk in terms of the worst performing outcomes for the portfolio. So in my mind, that actually is a kind of a early indicator that having factors or looking at factor trends in emerging in the developed markets may not be strictly applicable to India, and therefore I think we have to kind of watch our own factor performance first and then adjust based upon our own hypothesis. But what I have seen is I've not seen this very conclusive evidence to say that Indian factors will mirror what factors abroad have done. So if you take momentum during the course of last year, Indian momentum actually did reasonably well for the first 9 months, and then after that it really got whacked. Whereas if you look at momentum outside, they got hit early on and then started to recover towards the end of the year and the start of this year. So I think they are in two very different cycles.
Okay. So, Rajan, there's a question about the title saying all fact fixed. So I think the question answer to that is so somebody. So it's a fiction that that all factor strategies are same. All factor strategies are not the same.
That's
So
right.
I think that's so somebody I think was a little confused about the heading.
Yeah,
Um,
otherwise you would have called
I,
it a fact.
yeah, so we would have said fact. Yeah. Another question is, do factor-based returns cancel out in the long term, and do you get market type returns in the long term? So I think
We'll cover that, Anish,
we'll
in
cover
a couple
that.
of.
Yeah. So I think there was a question on correlation from Gaurav. So Gaurav, here's your answer. And so you look at the, we've taken value, momentum, quality, which is the long only indexes that we have of Nifty. Then Rajan explained BV, BR, BC, and WB, which is winner, big, robust, big value. And now you see the long short portfolios here, which are WML, CMA, uh, the quality portfolio, the RNW, and value you see HML and small minus big five, which just indicates it's from the five factor model. And you see the correlation between value, momentum, quality in the long only portfolios is fairly high, both in the Nifty indices as well as in the long only big portfolios. It's only when you get down to the long short that that you really see that there is we there is a lot of literature which talks about how value and momentum are have zero to small negative correlation, and they are extremely good diversifiers for each other. But when you have a long only market exposure, they tend to be highly correlated. Not to say that there is no diversification benefit from adding from having a multi-factor approach, which we'll come to, but you have to understand that while value has done well, long only value has also done well last year, and while momentum has not. But you would see that in the context of the overall market, that the Indian market did not do as badly as other markets. In fact, it's an understatement. It did much better than the other markets. So it's a, but within that, value stocks outperform, which is why you would see that the value index outperform. Uh, the factors are risky, and I think this is the point that Rajan was talking about. 3-year rolling sharp ratios. And Rajan, feel free to jump in here because you can explain this one better.
Sure. So the what we've done is kind of since 2000 since 2005 we've kind of taken the returns, calculated the sharp over 3 years. So it's a rolling period every month, and all that we are saying is how does the risk look like for an investor. The way to read this is one, anything below zero means for 3 years, the sharp is negative, which means the returns have been negative. So that's the first piece. The second bit is the wider or the taller the particular bar, the more volatile or the more wide the range is in terms of the outcome that you have, which depend upon when you enter. So if you were to enter, like I said, an unlucky investor had to enter, let's say HML, there would be a significant downside for a long period of time as compared to, let's say, a person who's entered, uh, I'm going to take the quality Nifty ETF. So the quality Nifty ETF, the unlucky investor who's unfortunately getting the worst of the returns is going to see a much better outcome than the unlucky investor who's coming to HML at the worst point in time. The reason why this is important is that uh, when you enter, the timing of your entry actually does make a difference as your final outcome or when you leave. And that is something that any investor knows. And all that this chart is trying to show you is the taller the bar, the wider
Why
the
does it?
list of outcomes, and then the lower it is below zero, the longer you're likely to be in the 3-year period where you're going to see negative returns.
Right. Uh, this is the other one that we were discussing. A fiction that factor diversification fails when you need it the most. And so we've taken one of the charts from the paper, and we've tried to show it in the Indian context. In the first one, where you see that in the period April 2017 to March 20, when value was down about 20%, uh, momentum and quality were up in the region of 5%. So they sort of protected you a little bit from the drawdown that you saw in value. Similarly, momentum in Jan 2008 to 10 was down, but quality and value sort of rescued you there. So what the paper takes is the worst 3-year rolling excess returns for any factor. The three most common ones are value, momentum, and quality. And the third one is when quality was down. Uh, Unfortunately, the value was also down slightly, but momentum was up. So you would have seen some amount, not that much benefit from having all the three factors, but you would still be better off than just having a single factor exposure. So, so this is the the fiction that sometimes is given out that you just go single factor and you go all in, or I am a quality investor or I am a momentum investor. But as Rajan always reminds me when we have discussion on this point, that he just says diversify. That's the best that you can do. That's the to repeat a cliche, the only free lunch that is out there. This is the same one, but for the big value, big robust, and from Investpar's data set that Rajan puts out every month. And here again, you would see something similar, where value in 2010 to 13 was down. So was momentum, but quality, robust companies were up a bit. Similar you see in Jan 2008 to 10, where momentum was down quite a bit, but value and conservative were flat. The next one is that uh, factor discipline generally trumps timing, tinkering, and trading. So, as we said, that each factor has its time. They are cyclical. They they sort of tend to do different things at different points in time, and so that obviously brings a very human tendency to try and time these things. And that's another conversation I keep having with Rajan, saying that can we sort of figure out a way to effectively time this, because you can approximately do it, but I don't think you can do it. At least I haven't been able to come across. I've looked at many methods, and we'll also talk about a little bit in the next one. But so what we've done here is, we had written a paper last year on the conservative formula. So what Rajan has done is taken the conservative portfolio returns and taken the 3-year rolling correlations between the factors, and you'll see the interesting part that the correlation to the CMA, which is the quality factor, how cyclical it is. It comes down dramatically in 2009, catches up a lot in between 2012 and 2020. That's when quality has had a great run, and then falls sharply again in 2020. Similar for momentum. Again, it's fallen in 2020. Value has been a constant, almost a constant, not completely, but it's also been in a range, but less volatile in terms of correlation than the other factors. With that, Rajan, over to you on crowding of factors.
So the other question that commonly comes up is that in India, because the market is so thin, factors are crowded, and therefore you should not be going into factor investing. Uh, so one of the ways that we have to all recognize that the Indian market is actually top heavy, and liquidity does fall off very quickly after the top 50 or by market cap within on any given day. So if somebody comes to you with a small cap portfolio or a factor based small cap strategy, one of the questions that you really got to think about is there capacity within the market for that? And especially if they have rules which are kind of, I need to rebalance on a particular day, it's quite easy to go back and do your diligence to say, is this something that's going to happen? One measure of crowdedness of factors is the valuation spread. So the way one would think about it is that if the characteristic that you're looking at versus the characteristic that you don't like, characteristic that you're looking at should be, let's say, valued more than the characteristic that you don't like. If that is the case, that is, there is a bit of up and down, that means that there is still capacity within that particular factor. When it turns out that the market values both the characteristics exactly the same, then the valuation spread comes down to zero. So in this particular case, we've taken momentum, and the momentum, big big momentum and winners, and the big momentum losers is the spread that we are looking at. Again, this is available in the data set, and all that we are doing is subtracting one from the other, and you see that it actually varies quite a lot every month. And it does show you that the market is valuing these two characteristics very differently, and therefore uh, these are not yet crowded in the large cap space. And I want to keep emphasizing the large cap space. In the next slide, we do the same thing for value. This is the value factor. And once again, you'll see that the spread between, and this one I've done HML monthly, so we've kind of created a monthly version of the value factor. The portfolios are rebalanced monthly, and we've kind of taken the spread between the cheap companies and the expensive companies, which again kind of bobs up and down, showing that there is still a spread, and the factors are not yet crowded. If we did the same thing for the small cap, then the story may look very different, especially for those um, where it's an implementable strategy. Of course, the academic strategies will not really give you too much of information because these are purely theoretical. And so, if you were to put in a large order into a small cap, it's actually not going to move. There won't be any slippage in the price. Uh, so, with that, Anish, there was one question by Yogesh which I just wanted to kind of pick up, which is how
Yeah.
to integrate data in slide 12. So, should I just take 2 minutes to just cover that once more, please?
Yes, please. I'll go back to that slide.
So, Yogesh, the way I think about this is the following. The first thing that I would look at is the adjusted R square or the R square, whichever one you want, because that is effectively the goodness of fit. If the goodness of fit is high, it basically means that the academic factors are doing a good job in explaining the average portfolio returns for the particular strategy. And so now I'm going to just take one, just so that we can work our way through one rather than all of them. So I'm going to take the quality, which is the one on the right hand side. Now assume that this Nifty quality index was actually a strategy that was being told to you. So the first thing I would look for is, where are the quality factors? And over here, the two quality factors are RMW, which is robust minus weak. So that means robust companies do better than weak companies, and conservative companies do better than aggressive companies, CMA. And so what I would be looking for here is looking for positive values rather than negative values, and I would be looking for some form of statistical significance. So if, for instance, I had 0.26 with no statistical significance, effectively it is telling me that CMA, assuming that is in CMA, uh, actually there is no statistical evidence to show that there is an exposure to conservative minus aggressive. So therefore, in that particular instance, the only exposure I'm getting is to the robust minus weak, which is profitability, right? So that would be step number one. If I find that there is exposure, I would go back to the question Anish asked, which is, how much should I look at? And like I say, that actually depends a lot upon your personal circumstance, how this is fitting into your portfolio. So there's a variety of factors, variety of considerations around that. The next piece that I would look for is, again, I would go and look for SMB. This is the size factor. If I'm going to see a large positive there, it means that the returns are being explained by the small size companies. In India, small size companies, at least for me, is an amber flag because that tells me that there are potential implementation issues that I should be watching out for. So when I have my conversation with the advisor or the manager who's trying to sell this to me, I will ask a lot more questions around how do you execute? How do you make sure that there's liquidity? Is there any gating you're going to do? And all of us know that there have been unfortunate instances like this across a variety of instruments over the years in India. The next piece I would look at is the market factor, the MF. Now, in the case of quality, it is showing it is 0.89, which means that this is a kind of a lower beta portfolio. If my overall portfolio is a high beta portfolio, adding this particular strategy to my portfolio helps me in reducing the overall beta for my portfolio, which for me is a good thing. It may not be good for you, but that is another thing that I would look at. My final element is actually looking at the intercept because that intercept really is just going to give me whether the manager is giving me alpha or not. But as at least for me, the alpha is the last of the things that I look for because returns, I'm not chasing returns. I'm looking for a better portfolio for myself. And therefore, a strategy that helps me make better portfolio is what I would look for. So hopefully, Yogesh, in kind of a couple of minutes, I've taken you through how one could interpret this, and you could just try it out for any of the other ones.
Yeah,
All right,
and I think
Anish,
it, yeah, this is a good segue into the next slightly more interesting. This was a lot of data, so I think a slightly more visual interpretation of a lot of things that this is very interesting tool that is there on QFinar, which has been developed by Rajan and his co-founder. And I think Rajan, if you explain this, we've taken a very popular multi-cap mutual fund, and we've tried to see what are the kind of factors that this manager is taking on. Sometimes investors are taking these on intentionally. That is that is what they're tilting their investment portfolio towards. Sometimes they are unintended. So Rajan, if you can explain how you've come up with the rolling
sure,
replication weights.
sure. So just like what we did in terms of that slide 12, we've kind of taken the same underlying data. So we take the data, the monthly returns from the fund or the strategy, and then we have the academic factors. And then what we do is we run a rolling regression that has got a certain set of constraints, so that everything we kind of break it down into what are the styles that the person is. What are the styles that the fund manager is trying to uh, build out of his strategy. Now, this may be explicit or implicit because sometimes fund managers choose they'll verbalize a particular strategy, and unfortunately, given the small universe that they are constrained to operate under, they may get knock-on effects that other things that will come out as part of the strategy. So in this particular case, what we show is we kind of replicate how the fund returns are by kind of breaking it down into large cap, small cap, value, quality, momentum, and low vol. And what we've done is we've actually taken either existing ETFs that are available in India or failing an ETF, a fund that tracks the index. So therefore, these are all replicable and accessible investment strategies that you and I, as a retail investors, can have access to. What this particular thing is showing us is one, the manager is actually pretty stable over the last 30 months in their strategy. It is a largely small cap kind of a fund with momentum built in. There has been an exposure to large cap in the first half, which then has got tailed off as it gone back into the small cap. So it shows that the fund manager is also taking some strategic calls. So that's how I would look at what this is telling me. So now when I go back and have a conversation with my wealth advisor, and I'm trying to say, let's say this is a fund, I'm trying to decide whether I want to keep within my portfolio or not. I first know what factors it has got. I also know from QFINAR what the factors of my portfolio are. And I can say whether one, there is some diversification going on, or this is a fund that adds value to my portfolio. Let's say it does not. I can have a conversation with my wealth advisor, which actually go and says that, look, what is the fund manager trying to do? So I can get some insight from the fund manager that says, let's say in this particular case, he's going to continue with the small cap and momentum. And I happen to like small cap and momentum. In which case, this is a fund I may keep with myself for another quarter or 2 quarters before I decide to exit. So this approach kind of gives you a returns based style analysis. That's what the technical term is. What it looks at is the returns of the strategy, and kind of breaks those returns down into these styles that we have created: large cap, small cap, value, quality, momentum, and low vol. And then it shows you how the style has changed, if at all, over the last 30 months.
Yeah.
So that's
And
the one on this particular fund. The next one actually shows a slightly more active process by the fund manager, where they have actually moved, at least for short periods, between between the large cap exposure. So it will be interesting. I mean, this is one fund if I had on my in my portfolio where I would definitely reach out to my wealth advisor to have a conversation to say what happened. Is this an anomaly? Maybe it is just the returns were unfortunate for the poor fund manager, and therefore nothing to worry about. Or is there genuinely what the fund manager has done is moved away from large cap exposure and actually introduced a much more multi-factor kind of an approach, which is something that one could look at. Siddharth, to your question on the attribution of returns, so this is, we actually just take the returns as they are for the overall portfolio. And this is I'm hopefully going to answer the second question, which is factor-based returns cancel out in the long term and you get market type returns. So the honest answer to that is actually, if you've got good factor exposures, the answer should be no. Because as we talked about right in the beginning, factor returns are not arbitraged away. As long as the factor is there, it will stay. Once the factor gets arbitraged away, then you'll get something like market return. But otherwise, you should remain to hit the factor returns. And so once we have the returns of the fund, we try and back solve as to what the person would have done. People like Morningstar actually do it the other way. They do a style-based analysis. So they actually take the fund, break down the individual fund into its respective stocks, and then based on the stock, they'll assign a style, and then they'll aggregate the style to give you a style-based analysis. Which is, if you have the style-based analysis and the return-based analysis, that really helps you understand your portfolio or a particular strategy a lot better.
so in that case, rather than they would be taking every stock, doing like a Z
Yes,
score, and
yes,
then adding up
yeah.
the.
That's right. There are both issues or both methods have their own pluses and minuses. And at least from my side, I would say trying to do a bit of both always helps understand the strategy a lot. Because the job of a fund manager is actually really complex, and I really feel empathy for many of the fund managers out there. It's a challenging task. And so when they try to either get alpha through stock selection, stock allocation, or timing, not all of that is always being reflected because the portfolio could cancel each other out. It's a complicated ship they're trying to navigate.
Yeah. In this case, I think at the quarter end, the fund
Yes,
manager was trying to do something and then
that's right.
get
That's
over
right.
there. It's very interesting. The next one is a value tilted fund.
Yeah. And again, here you see, not only has the person got exposure to value, he's also got exposure to low volatility, which has kind of stayed all the way through. So the piece that has kind of moved in and out is maybe there was there is a few stocks that the person has picked up that have had exposure to quality, that was coming as part of the returns. But then if you take that quality out, again, here is a fund manager who's been very, very true to her style and strategy. And if it's a fund that somebody's comfortable with, you know that the fund manager is not trying to do too much different from the strategy that the person has articulated.
Right. So I think with that we come to the summaries and the key takeaways that we want you to take away from this. And as Rajan has very articulately explained that we earn get factor premiums, not for free. It's not a free lunch. We get factor premiums because they go through bad times. Like Corey Hofstein says, "There's no pain, there's no premium." And you do have the pain could be in the form of underperformance for a long time. It could be in the form of drawdowns. It could be in the form of time correction, which is flat for a very long time. In the case of values had a terrible decade, and the last 2 years have been pretty okay, pretty good, I would say. Not just okay, but not many people would have stuck to value for 10 years. So that is a kind of as Cliff Aston sometimes says, for every year that a strategy doesn't work, he ages by 3 years. So you can imagine the pain that a person goes through when strategies or factors underperform. So it is for not for no reason that that this premium exists, and as Rajan explained, why it's not likely that it will be arbitraged away easily. Risks again, that that's what we spoke about. Rajan and has developed some very insightful and useful tools which are available on QFinar. Um, you can go there and look at your mutual fund or your factor funds. You can upload your portfolios. You can do a lot of stuff on there, and even if you have some, I keep asking them for some features, and very kind of them to sort of they work on it, and they've added a lot of stuff there. So they're very user driven approach. Then we also discussed that not all implementations are the same. I could have a different the as long as the economic rationale is the same, say if my momentum factor and the way I look at it versus the way Rajan looks at it, it could be different. For example, in a paper which we wrote a couple of years ago, long factors not short change, we looked at different definitions or different implementations of the same factor, where we took the academic versions and as well as the versions that are available to for investment, and we found that there were differences in that. So that is something you need to be aware of. It's not good or bad, but that's something you need to be aware of when you have that in your portfolio. Along with asset allocation, be aware of your factor allocation. So this is something that we'll do a session on at some other point in time, which is another fascinating discussion for me. Is the Norges Fund case study, where in 2008-9, uh, the usual way to do your portfolio construction is to do asset allocation and say that, okay, this is my equity, debt, commodity, real estate, gold allocation. But even in those factors play a role, but they definitely play a role in your equity allocation. So you need to be aware of if you're taking equity, but what are your return drivers, and is that something that you intend to do? Is that something that the fund manager is intentionally doing? And that's something to, understanding that will sort of help you stick to your strategy in bad times. So that is something that you need to keep in mind. And obviously the last one is stay disciplined. We've still not found the magic way to time factors or time markets very precisely. There are approximate ways to do it, but you can't still do it precisely. So best is to build discipline. Understand that if you go through some bad times, that means that there is a premium which you are going to earn over the long run. And the next one, which Rajan, which we will probably talk
Anish,
about.
yeah,
Yeah.
Anish. there's one question that is asked twice: how to identify which factor is presently running in the market.
Yeah,
So the ideal way to do that is you take the market and just run the same regression against the academic factors. The reality, as I've seen it, is it is almost impossible to actually tell which particular factor is driving the market at any point in time. Because remember, the market factor is still one of the largest factors you're going to get. So when you do that kind of an analysis, you're really going to find it's like in the ocean. You're trying to say, where is the current? Unfortunately, you'll not be able to find the current because the ocean is so large. In the case of, let's say you took the Nifty 500 and said that was the market, then if you ran that, there's another piece of work that I've done with somebody, with Sudesh at IMA, where we looked at how many stocks are required to kind of diversify away all risk. And we found that about 40 or 50 stocks were required. So if you have a random portfolio of more than 40, 50 stocks, it's going to be difficult for you to isolate out the the individual factors that are working within the market at that point in time. So there are two, three ways to look at this. First, actually look at how each individual factor is doing within that regime. And if you kind of go to the InvestPower website, you'll actually see what has been the. In fact, Anish also puts this out every month where he talks about what has been the returns of each individual factor, long only factor. He talks about that. Some of those factors you'll be able to know are doing better than others or doing better than trend. So when they're doing better than trend, it means that factor is kind of on the upside. If it is doing better than others, it is definitely on the upside. So what you'll have to really look at is how individual factors are doing. Remember, the long only side are only estimates of one angle of the one perspective of the factor. What you really need is a long short version. And the long short version between Anish's factor report that he puts out every month, or if you go onto the InvestPar research webpage, you'll actually see what the long short version of the factor has done. That should start to give you a sense. My other suggestion would be timing of factors is something that people are still looking for. If you found a way to do it, please let all of us know because I think we'll all give you a lot of money to say you can
yeah,
manage it for us. So I would also be very careful in the way I would interpret some of these results because factors tend to move quickly. Remember, factors are for the long-term returns, whereas they can move quickly in the short term. So with that, I'm going to come back in terms of what are the possible next steps. First is really to understand what factors are and their risks. I think this is something that I hope we've been able to highlight that factors are long-term return premium for short-term risks that one has to take. Once you've got your particular circumstance, your requirements, how your portfolio should be done, you can choose your factors. And I don't think that all factors are useful for everybody. Some factors will be better for some, others will be better for others. Then, based upon that, once you've decided upon the factors, then you can start to look at what kind of instruments that you want to go and buy. And there are multiple that are available in India now. I think India is actually really, really good because you're getting single factor exposure, multi-factor exposures. You see both the Nifty and the S&P, BSE indices. You got multiple a set of indices that are now being tracked by funds and by ETFs. Uh, Look at the experience and the expertise of the investment manager in this. How long have they been doing it? Is this something that they've just started? Have they had bad times? What is the methodology that they use to set up the factors? How do they choose their portfolio rebalancing? How transparent are they? Are they completely transparent in terms of when they make changes, or is there kind of a secret sauce that keeps within them? What kind of liquidity do they have? The instruments that they're buying, what kind of liquidity is available for that? So if there's somebody who's going to do a small cap factor fund with, let's say, 10,000 crores of AUM, they're doing it for 10 stock, frankly, that's likely to not move very far because the market is not going to be able to absorb. Uh, the purity of exposure, we talked a bit about that using some of the regressions or some of the tools that are currently available. So, worthwhile looking at the purity of exposure because not all factor funds are the same. And finally, do you want to take active or passive? The reason why at least in my mind, active or passive, I think is an important discussion because there's some really good fund managers who somehow have the secret sauce without necessarily the math. And therefore, for them, uh, you may say that this is a great value manager. I'm going to put money with this person because I'm getting exposure to value factor. Or you do something that is passive, right? These are standardized systematic rules which actually do really well. There is no bias in there and all of that stuff. So active or passive is actually an important decision to be made. And again, in India, there is enough availability of instruments both on the active side as well as on the passive side. And finally, monitor regularly. I would suggest once every year is the bare minimum that you should be looking at. If you look at it every 6 months or every quarter, my only suggestion if you do it too quickly is that you will tend to get biased one way or the other. And remember, factors are there for the long run. They're not there for the short run. Right? Choice of factors. There's one last slide that we have around it. In terms of how you can look at what factors you want. Uh, I would say the most important part here is please look at the history. Look for the bad times rather than the good times because when the bad times come and you are likely to get stuck with the bad times, you need to be able to say, I'm comfortable with this. Finally, look at how operationally it's going to get implemented. Are they liquid? Are they traded instruments? What are the costs they're going to give me? What are the implementation risks? Is this a good fund manager, not so good fund manager? So there's a bunch of stuff that is more on the downside that I think one should be looking at rather than on the upside, which is what the marketing people will sell you in any case. So once you have had the marketing person talk to you, then I would say go and spend some time to look at the downsides before you choose it. And with that, I think we are done.
Yeah, I think we just had the last appendix where we had the thing from our paper on what's been the average rolling alpha, 3-year alpha, before costs and after costs.
Yeah. Again, I just like to remind them that this is all stuff that we've done. These are more theoretical than actually implemented portfolios. But we calculated how much the costs are likely to be. So these are all our estimates and slippage.
So, so Rajan, with that, the last question, if you had to say, I know you won't predict, but if I had to ask you to predict which factor is going to do well in the next 3 to 5 years.
So market factor will always do well. So that's something you should have exposure to.
Yeah.
No, actually, so in my mind, I think it's difficult to predict. Uh, my own approach, Anish, has been to be more multifactorial in the orientation.
But
Uh,
given how value is done, you think that is something that will sort of come back with a, or is it no? We should not be trying to predict that and say that okay, just
so again, I would come back to because at least for me, my portfolios are kind of long term, as in multi-decade. So I know that I'll be able to get myself exposure. Some of these exposures are cheap. So if I get into the exposure now, I know I'm getting it at value. But when I realize that value may be many years away. So as long as I remember that, I think that's something that hopefully will kind of add up. The most common ones that tend to bounce back, momentum tends to bounce back the fastest. That remains there quite a lot. Quality kind of doesn't necessarily keep going down a lot, so it has a much shallower drawdown. Value, unfortunately, has had a actually, it's been multi-decade drawdowns in the US, but now starting to slowly start to come back. Even though when you look at the value versus growth spread, it is still on it's still on the lower end
yeah.
of the spectrum rather than the higher end of the spectrum. So that's why, in my mind, Anish, I feel that it's better to think about the factors that you like the downside that they have. So if I was, let's say, 50, 60 years old, and I know my portfolio is going to kind of mature over the next 5 years, and I start to need the cash, momentum may not be the place I would be in, right? If I'm 25 years old and I have a long time horizon, momentum may be the place I would be in. Would I put 100% of my money into momentum? I don't think so. But that's me. I'm a much more balanced person from a risk point of view. So I would choose how much I want in each of these factors at this point in time. If I'm putting fresh money,
So you would go in for a you and if you were combining factors, would you say that would you put them separately in separate sleeves, or would you take a multi-factor approach in one portfolio?
so again, an excellent question, Anisha. And I think here again the jury is out. There is a case that having a multi-factor approach in one strategy allows you to harness the diversification that you would get, but that assumes a large portfolio of stocks or a large portfolio of instruments. In the case of India, since what I've seen is that most people are in the Nifty 200 top 30, and if you kind of look at what sits in the top 30, you actually find that there's a reasonable amount of overlap. So getting multi-factor exposures kind of becomes moot because you're effectively getting the same underlying instruments getting repeated. So in the Indian context, I think a sleeve approach for me is preferable for me because I know how much exposure I'm getting. Whereas if I look at it in other markets, then a multi-factor approach is kind of better because then the fund manager does the work for me in terms of allocation between funds. So it does come back honestly to what your needs are and how you think about your needs and what is available in the market.
I think one last question which is coming up a couple of times is for taking long-term average as benchmark, the results of 5 year versus 10 year is quite different.
Yeah.
Now, for which time period do you suggest to consider 5 year or 10 year?
So actually, again, an excellent question. Long-term estimates are usually wrong. Most people get them wrong. That's unfortunately the case. But at the same time, history remains a kind of a good baseline to follow. So what what one can do if if you have the ability or your wealth manager has the ability, you can actually take history and then you can take views from the rest of the market at this point in time and combine them pretty nicely from a statistical point of view to get a return. But if you can't do that, my kind of naive process is I would take the longer the period, the better it is. Again, there's a small piece of work that I've been doing around long-term returns in India. That's available again on that's available in public. But what I've done is I've taken since 92, which is where I can get reasonable amount of data in. I've taken it for stocks, bonds. In the case of property and all that is real estate, it is a lot more recent. Gold, and fixed deposits. So these are returns that have happened so for the last now since 92. So I'm talking about 30 years. So that kind of gives you a sense of what returns can be, but also gives you a sense, more importantly, of what the downside could be. So I do this both from a real basis, which is taking out inflation, as well as a nominal basis, excluding inflation. So if I tend to use those numbers as my naive forecast of what long-term returns are looking like. There's for those of people who are looking at international markets, there's an excellent piece of work by Dimson, Marsh, and Staunton. They've got return data going back into the 1800s across multiple markets. So that could be another useful resource. For those who know Deutsche Bank also comes out with on an annual basis long-term return estimates, and India is one of the markets that they have. So that could be another one that one could. So the longer the period, the better, and there is data available for free that you can actually get on the internet.
I think Gaurav Raizada has a question. Is there a sequence of factors between market peaks and troughs? Like earlier, there was small cap falls and mid
Yeah.
cap and large cap in bear market recovery. So, is there some kind of cyclical, some sequence in the cyclicality of factors?
Well, like I said, if we had figured that one out, I think we would be managing a lot more money. The honest truth is, timing of factors is still a challenge. There are some studies that talk about the existence of factor momentum. So there are some studies that have shown that, and then there are the counter studies that actually talk about why those studies are kind of biased, and they kind of argue the other side. So effectively, your question does come back as to is there factor momentum, and I would say at this point in time the jury is still out. But it's
Thank
useful
you.
since you're a PhD. Yeah, it's useful for a PhD student to kind of work on a PhD on this.
Yeah, absolutely. I think Rajan, I think you've explained a lot of concepts and answered. And we've gone half an hour over time, but you've been very generous with your time. And there are requests that please make a 8 to 10 session kind of course for this, and please put it up somewhere. And I don't know how I think the bar is pretty low, saying that this was far more valuable than all the options seminar combined. So thank you, Yogesh. I think thank you for all your questions. Thank you, everybody, for participating. I think it's always fun when more people ask questions and have questions where that makes it more interesting for us
Yeah.
to take these sessions.
Well, thank you,
Any
Anish. And
closing remarks, Rajan?
as they say, be long factors.
Okay. So with that, yeah, absolutely. So So with that, Rajan, thanks a lot, and
Thank you.
we'll come to the end of this broadcast today. Thanks, and see you
Thank
again
you.
next
Thank you.
month. Bye.